Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Tuesday, February 20, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. There's a lot of lines on the chart. It looks a little bit confusing. Let's clear it up real fast. It's pretty simple. What we're looking at, we'll start at the top. So the two red lines at the top are resistance lines. On Friday, we almost hit. We came very close to the thicker red line. Let me move this over and I'll show you. The high from Friday was 275.32. This particular resistance point I had drawn in at 275.50. So that's a near miss. It's basically a hit for all intents and purposes. And then the market backed off that level. It's also a pierced through the 20-period moving average and then backing off that as well. So here you had the 20-period moving average and a resistance point right above. That was pretty formidable resistance for now. The secondary line above it at 280.23, if in fact we were able to at least close above the 20-period moving average on the daily chart, and certainly if we were to close above 275.50, then that 280.23 comes into play. So there's your two resistance points on the upside. If we were able to get above on the daily chart 280.23, then we're looking at all-time highs, or at least at minimum a test of the all-time highs. Now let's go to the other side, or the other direction. And you have three green lines on the downside. The first one is at 269.72. This is the first level of support, and we almost actually got there today. However, it's the first level of support that the S&P or the spiders would see on the downside. And then the two levels below that, 266.76 and 264.12, same scenario. These are support levels on the downside. I don't think that the 269.72 would be all that we would have on the downside if we're going to see any kind of selling in this market. Now, right now, and here's the interesting thing, right now, there's really no downtrend at hand. We're just going sideways. Well, we had a down day today for sure. In fact, the S&P was down 16 points. The transports, which we'll get to, were down pretty large, and the Dow was down 250. But for all intents and purposes, we just basically closed below the 50-period moving average, but there's really nothing wrong with the market just yet. If we went sideways for another few days, 2, 3, 4 days like this, that's essentially a bullish pattern off the lows, so we would have an up move, a bullish pattern, and maybe we actually touch this particular support level at 269.72, but if we did, that would create another lift to the upside potentially. So basically what we're doing is we're trading, or at least analyzing, the market that's in front of us. I'm not here to tell you that on Thursday the market's going to be at 265. We can't do that, right? We don't know that. That's more of a guess than anything else. But what we can do is look at the chart pattern that's in front of us and say, here are the highest probabilities based on what the chart is doing. This is what the chart is telling us the market wants to do. Right now, the market is essentially finding resistance at the levels we thought it would. Now it's backing off yet, but we haven't really put in any kind of meaningful sell just yet. And the reason why today's 16 points on the S&P isn't a meaningful sell yet is because it really wasn't met with any kind of tremendous volume. When you look down at the bottom, you see we had about 90 million shares traded in the Spider. Now, 90 million sounds like a big number, but all in all, it's not a big number as compared to the volume that we've seen over the last couple of weeks. You've had a 300 million, almost 350, a 300, a couple of 300s, 250s. So you've had some, significant volume over the last few weeks, and today, in comparison, is really a lighter volume day. It was a 3-day weekend. This is the first day back from the 3-day weekend. So let's give it another day or two to start to develop if anything on the downside is actually going to develop. Now, what we also have to do is separate out what the chart is telling us versus an opinion. It's okay to have an opinion, but you have to be able to pivot away from that opinion if the chart is telling you something different. I have an opinion. My opinion is I think the market's going to come down farther. I think we're going to test at least the 266.76. Probably, if we have any kind of hard sell, 264.12 will be tested. That's also the 100 period moving average or slightly below it. And that would create an ABC pattern. And the ABC pattern would look like this. You have an A move off the bottom. You have a B leg down, and it would cut somewhere in here or all the way down here. And then we could potentially have the makings of another C leg up. Doesn't have to necessarily make new highs. It's way too early to have that conversation just yet. But the ABC pattern, or also known as a zigzag pattern, is certainly possible. The markets like to do that over and over and over again. Now, based on Friday's close, we talked about a couple of important levels. So you have a pivot high here, and that's important. It's the market telling you that price level is important. It also somewhat coincides with the 269.72. That's our first level of support. Then you have some consolidation that took place, and that's the market's way of telling you, also you have another pivot high here. That's the market's way of telling you that this price level is important. You see how the market found support as it was consolidating to go higher right at that level, and then it broke out to the upside. As we know, and I've said this dozens if not hundreds of times, markets love to come back and test former breakout and former breakdown areas. That qualifies the 266.76, give or take 25 or 50 cents, but not even 50. That qualifies for a former breakout area. So that's the second support level. The third support level coincides with a normal retracement level. There's another support or consolidation area in this zone. You also have the 100 period moving average right down here. This would be a nice garden variety retracement setting up for most likely another buying opportunity in the market. Doesn't have to be a long-term buying opportunity. It could be for a few weeks. It could be for a couple of months. But it could set up another buying opportunity at that level. So if we did come down to the 100 period moving average, give or take 264 on the spider, that likely will present a buying opportunity. If we began closing below, significantly below, the 100 period moving average or the 264 level, consecutive daily closes below that level, and that's the market's way of telling us that it would most likely want to go and at least test the old lows or the recent lows and potentially go lower. Again, it's a little early to have that conversation, so let's just deal with the market that's in front of us today. And that pretty much covers the daily chart of the spider. Now I want to discuss a little bit about the intraday, and we'll throw in a little chart lesson right out of the course at lazyminitrader.com. Here's an intraday 10-minute chart, and we're going to talk about patterns, price patterns. Okay, so here, everything to the right of the vertical black line that I drew is today's activity. So basically what happened was the market sold off early, tried to rally back, found some resistance. However, what it was doing was it was putting in a bullish pattern. And anybody that's taken my course understands and knows what they're looking at with this bullish pattern. This was the market's way of telling us that it was likely going higher. Now we have a specific level that we're looking at to ensure that the market continues to close above to say, yes, higher prices are coming. However, that level was breached, and that level is right here. Once the market closed, and you could be looking at the S&P E-mini futures contract, you can be looking at any chart, they all act and react the same way. However, anytime the market closed below, or the fact that the market closed below, this green candle low, that was the market's way of telling us that that bullish pattern was off the table and the probabilities were no longer to the upside, but the probabilities were now shifting to the downside. Now we have another green candle low here. So you can see where the market found support on a temporary basis when we reached on the downside that green candle low. That's a support level. But what happened was, let me clean up the chart, and I'm just going to use one particular pattern that developed in the afternoon, and that told us that the market was likely going lower. So we had this down candle after the bullish pattern was broken. All right, and everything that I'm talking about here is in the course at Lazy E-mini Trader. This has gone over in detail because these patterns, these price patterns, play out on each and every chart all day, every day. Whether they're bullish patterns or bearish patterns, they play out all the time. So now the market has a down move, and then we began to consolidate sideways. And we consolidated for a specific period of time. And that's also what's extremely important. Very specifically, I discussed time is more important than price, and I go over in detail how to determine the right timing and when the market is likely to make a move. All that's discussed in the course as well. So now we make this bearish consolidation pattern after the bullish pattern was broken and off the table, and this was the market's way of telling us that it was going lower. Now, some of you might be saying, well, I don't get what he's saying. I don't understand exactly what I'm looking at. Listen, all this is really gone over with a fine-tooth comb in the course. What I wanted to do is just point out the fact that the market is not a mystery all day, every day. Some days it is a mystery, but for the most part, the market is telling us what its likely intentions are. The market will tell us with a high degree of certainty most of the time which direction it is headed by virtue of the price patterns that are formed on the charts each and every day. Now, the patterns that we see on the 10-minute chart, you can see similar and the same patterns on an hourly chart, a daily chart, a weekly chart, a monthly chart. They're all the same. They all act and react the same. The shorter time frames will play out in a faster manner, and the larger time frames will take longer to play out. An hourly chart will take hours to play out. A daily chart will take days to play out. That's where your swing trades come from. Intraday trading is traded off of a 5-minute chart for some people. 10-minute chart is what I like to use. 15-minute charts, you can use a 30-minute chart. Again, the longer the time frame, the longer and the more time that price pattern needs to play out. All right, so there's a little chart lesson 101. Now let's go over to the IWM. What you'll see in the IWM, I'm going to stay on the 10-minute chart for a second, because what you'll notice here is that the IWM had a pretty decent rollover in the afternoon. So at about noontime, the IWM made a high, and then it basically was perpetually down and rolled over for the remainder of the day and actually starts to put in another bearish pattern. So we finished down about 0.8% or $1.23 in the IWM, and what you'll see when I flip back over to the daily chart is we got back below, and this is only going to be extremely important at the end of February, but we got back below the upsloping trend line drawn over from the monthly chart. When I bring up the monthly chart, doesn't look like we're below it here because it's a long-term chart or big numbers, but this is the upsloping trend line that I'm talking about, and when you look at the daily chart, you can see we're clearly back below that level. We came in and just kind of snuggled up against the 100-period moving average today and bounced off that level. So the IWM showed some weakness today, and as you know, this is my favorite market leading indicator on the up and the downside, and certainly the market, or the IWM, was somewhat leading the markets in the downward direction. Not by much, but it was certainly slightly down more than the spider today, down quite a bit more than the NASDAQ. In fact, the NASDAQ finished flat for the most part. The composite was down 5 points, but the NASDAQ 100, if I'm looking at the futures contract right now, it's actually up 3 points. So we'll call it flat, finishing flat for the day. So the NASDAQ has yet to really roll over. The Qs were actually, as I make this video, are up 51 cents, which is basically the same as the NASDAQ 100. So just rounding out the daily chart of the IWM, we had the lows that were put in, we had the tremendous rally, we went right up into the convergence of the moving averages. We talked about this based on Friday's video, and the market was essentially rejected at the moving averages, and now we're back below that important trend line. But that trend line really comes into play at the end of February since it's from the monthly chart. What's important is where we close the month of February, or each and every month, above or below that line. If we close below that line, that could be seen as a failed breakout. We'll talk about it if it happens. We have to see the price action and the activity around the end of the month to really discuss it much further. But we're in the same camp in the IWM as we are in the spider. We still are in a position where we could just, go back and forth in this range for a while, and that will be putting in a bullish pattern eating time off the clock, building some energy to go higher. That's a possibility. We talked about that Friday. We're talking about that again today because we don't have enough evidence of any further decline or anything like that. So basically, we've just had a sideways day since piercing through and being rejected at the convergence of the moving averages. If we get back below the 100 period moving average, that's going to tell us a lot of information. If we stay above the 100 period moving average and continue to close above the 100 period moving average, that's going to be a different set of information, but all important. We need the information to put the pieces to the puzzle together. Once we have each piece to the puzzle, we're able to put together the highest probability and likelihood of where the market is going. Right now, we just don't have enough information because we just, from Friday's close, backed off the convergence of the moving averages. So tomorrow's activity will tell us a lot more than today. And again, even though it was a down day, it wasn't on a tremendous amount of volume, less than the average 90-day volume, just like the S&P 500 or the Spider. Same deal goes for the IWM today. So even though we had a down day of almost 1%, it wasn't on any kind of large volume. So we know that there wasn't a tremendous amount of institutional participation on the downside today. So we wait. We need more evidence. We need to see tomorrow's action. Now, the transports sold off pretty good today, down 1.5%. Now, remember, the transports were the canary in the coal mine way back when the market was making highs. So way back here, the transports were the first index to roll over before the IWM, before the S&P, before the Dow, before the NASDAQ. The transports were the canary in the coal mine, headed lower, telling us that there was likely some downside coming in the market, but none of the other markets had cracked yet. We talked about it at the time, but the other markets remained strong for quite a bit more time while the transports were showing weakness. Now, the transports showed weakness today. We'll see if that's further evidence of other markets to follow suit in short order. Now, remember, the transports were not able to get through this breakdown candle high. That's item number one. So we pierced through it on Friday, and today we sold off pretty good, coming very close to the 100 period moving average. Let's see if we get below the 100 period moving average on a closing basis tomorrow or not. That'll tell us and give us a lot more information going forward. Now I've got a chart of the financials. We'll use the XLF, which is the Spider ETF that covers the majority of the large financial institutions. The reason why I want to bring this up is because of what I always say. Without participation from the financials, whether it's on the downside or the upside, it's unlikely the market, the major market, is going to follow suit without the financials. So we didn't have a down day in the financials or the XLF. Down 3 cents, that's a rounding error. That's a flat day. So we didn't have a down day in the financials while we had a nice down day in the transports. We had a nice down day in the S&P 500 and the Dow. The NASDAQ we talked about was flat, and the financials were flat. So without participation from the financials on the downside, it's hard to look for much downside across the major market indices. Are the financials simply consolidating up in this range up here? So are we just going back and forth, consolidating for another push higher? This would be a bullish consolidation pattern, building energy, eating time off the clock for another move higher to challenge this red candle high up around $30 and potentially the all-time highs. That's one possibility. Another possibility is obviously the financials roll over and we're just lagging in terms of time. A third possibility, and this is something I'm looking at and I'm watching the financials very closely. If we see, for example, let me bring back up the Spider chart and then I'll go back to the XLF. So if we see, for example, the Spiders come down to some of these support levels. So let's say the Spiders came down here, or they even came down all the way to the 100 period moving average. However, simultaneously, the financials, and we'll go back to the XLF, the financials really don't have much of a downside. Let's just say, for argument's sake, they stay somewhat in between the 50, which is the blue trend line, and the 20, which is the red trend line. Let's say they stay sandwiched in between those two moving averages and just go sideways while the S&P sells off a little bit more down to those support levels. That's going to be the market's way of telling us that it's likely it's just a pullback in the S&P, and the financials are signaling that it's a buying opportunity across the markets. So that's going to be an opportunity to put on some swing trades. That would be the financials' way of showing what's called relative strength. I don't know that that is going to happen. I'm just saying that if that does happen, and I'm watching out for that to happen, because right now we do have a bullish pattern developing, and we are in a pretty decent position in the financials of the XLF. Really, as long as the XLF stays closing on the daily chart above that $28 level, that's still going to signal more upside coming and the development of a bullish pattern. So I'm watching the financials very closely as I'm watching all the markets across the board. All right, now we'll switch gears and we'll talk about the gold market a little bit. Gold took a big hit today, down almost 2%, about $24.50. Remember what I said based on Friday's market activity. What I said was, as long as gold stayed above the 1319 level, that's technically still in an uptrend, still technically in a bullish pattern. Now, I didn't think it was going to come down in one shot, $25. However, it doesn't matter what I think. What matters is what's happening and what has happened. And what has happened is gold had a terrible day, and another day like this, and we will challenge that 1319 area. If we close below 1319, and the exact number is actually 1319.10. If we close below that number, that'll also mean that we're touching or closing below the 50-period moving average. If we breach that level, then the likely scenario is the upside that we talked about up into the $1,410 give or take area is going to be off the table for the time being. But the other thing that we also know is it's the market's job to make as many market participants look like fools as much of the time as possible. So it is possible that gold will come down and test some of those lower levels, maybe touch the 50-period moving average, but close back above 1319.10, and that'll still technically have a bullish pattern intact. Close below those levels, and the likely scenario is the first real true level of support will be down here, and if we close back below that, then we're coming all the way back down to an area like this. We don't have to discuss specific numbers right now. It's a far cry from some of those lower levels, but I just want to point out that if we close back below and take the bullish pattern off the table, 1319, then some of the lower levels will come into play, and we'll talk about them then. Tonight, we'll talk briefly about the GDX, and there's a reason why. Because this is exactly what I was just talking about with the gold market and what would keep the bullish pattern intact. But look where the GDX closed. This is a basket of gold mining stocks. Look where GDX closed today. It closed below the low of this breakout candle. The low was 21.94. We closed today at 21.87. That's not an accident, and it's not a coincidence. Certainly only by pennies. If they chose to close the market above that breakout candle low, then they could have, but they didn't. So I think it's an important development, and I think it's a signal of what's likely coming in gold. This is weakness in the GDX. That was an important level. So this is basically a failed bullish pattern. Generally, when you see a tremendous up move like we had a few days ago, okay, and it's common in normal market behavior when we run into a convergence of four moving averages, right? The 200 period, the 50, the 20, and the 100. It's normal market behavior for us to back off from that level. But what we could have done was had a simple garden variety pullback and setting up for another move higher. So that's what normally would happen. But this is not normal. What we did was we retraced and closed right back below that breakout candle. That's negative for the gold miners. That's telling me that the gold miners are going lower. If the gold miners are going lower, it's likely gold is going lower. And that's why I wanted to point out and bring up the gold miners and the GDX chart today. Sometimes one market will signal what another market is likely to do in the coming hours or days, and that's what I'm getting from the gold market and looking at the gold miners or the GDX. Crude oil, a very slight update today. We're sandwiched in between the 50, which is the blue trend line, and the red trend line is the 20-period moving average. We went up and tested the 20-period moving average, but closed poorly, or will close poorly today, near the 50-period moving average. Needs more time. We need more time to push higher. If we're going to push higher, it's going to have to put in some kind of consolidation pattern, preferably in between, sandwiched in between these moving averages. We need more time. We need more evidence from the crude oil market. We had a tremendous rally off the 58.25 level that we identified long before it got there. Now it was overbought on a very short-term basis when we got up to, let's say, even today, we got up to a high of 62.65 from 58.25. That's a pretty good rally in just a few days in crude oil. So now it needs more time. It needs to buy some time or eat some time off the clock, consolidate if we're going to have another push higher in crude oil. So we need more evidence. There's no long, there's no short. We're just watching crude oil, looking for this market to give us evidence of where the next likely move is going to be. And with that, this video is getting a little long in the tooth, so I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.